Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It will help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Michael Nowakowski, Managing Director and Head of Structured Credit at Conning. Conning is an investment firm that manages over $190 billion in assets on behalf of insurers and other institutional investors globally. Mike, really appreciate your time. Pleasure to meet you virtually. Thank you for coming on the show.
Thanks, Todd. Thanks for having me.
So I think, a good place to start, considering that we're near the start of the year. We're not exactly at the very start of the year, but we're still in the first month of the year. Considering that we are starting a brand new year, where would you say we are in terms of the state of structured credit markets today after certainly 2025 had ups and downs and Liberation Day and lots of other things with rates? Where would you say we are in terms of the structured credit world?
Yeah, I think that's a good place to start too. And I know we're beyond the Larry David Happy New Year threshold, but Happy New Year anyway. So at year end, we get a lot of outlooks for the next year. And I understand that year end is a good natural inflection point to take stock of things. But honestly, in our eyes, not a lot has changed since last May after we got through all of that tariff volatility. Since then, it's been a period of pretty tight range-bound spreads with really low rate volatility, which, quite frankly, has been a good environment for carry. And we don't really see a whole lot different today. There's obviously lots of headlines swirling around, but the market seems to be looking through most things so far. Broadly speaking, the structured credit market's in a good place. Supply is fairly elevated in CMBS, RMBS, ABS. But we've seen dealer inventory is really light. New issue subscription levels are really healthy. There's plenty of demand to meet that added supply. And I think part of the reason is because fundamentals seem to be on really solid footing as well. The U.S. consumer, in the aggregate is chugging along. Housing market's still tight. We don't see a ton of risk regarding excessive home price declines. You've got commercial real estate fundamentals on the upswing. Increased transaction volume, transparency, all things we've been looking for the last couple of years. The only potential ding on this market maybe is how tight spreads are starting at and how flat the credit curve is. But again, that's definitely an effect of the period of low volatility that we've been going through since really last May.
And where would you say are have the biggest potential to kind of throw up a red flag in today's market?
Yeah, I mean, despite this low vol environment, things seem pretty rosy. But I guess that is in and of itself one of the red flags. Spreads are tight, demand is really high. That's one of the things that keeps me up at night. And with that, you can see some collateral quality and documentation degradation. A little bit of late cycle behavior can definitely affect those things. So it's really important to take a step back, take an extra step of caution in our underwriting. We don't mind passing on deals right now. I think, in fact, at the end of 25, I would say that we were passing on more deals than we were actually participating in. So that's one thing. I think the other thing, I mentioned the consumer in the aggregate, but really when you break that down a little bit further, it's pretty well documented that the top 10% of income earners in the US are really, the engine of consumption right now. That's a little bit more concentrated than we would like to see. Obviously, would prefer to see a broader breadth of spending across income cohorts, but for now, it's enough to keep the ship afloat. And I guess lastly, on the point I made earlier about collateral quality, thankfully it's been unchanged mostly for the most part. On the resi side, the borrower quality is stable. Consumer and auto ABS, most management teams have tightened their credit boxes over the course of 25 in response to some of that K-shaped economy that we spoke about. But we've seen a couple of issuers toss in some collateral that really was not in their normal guardrails of their business model. So we've we've shied away from that behavior. We want to stick to our knitting. We hope issuers will stick to their knitting. Uh, but ultimately, just that extra step of caution in late cycle behavior.
What about the impact of the growth of private debt and private credit coming into the markets? I mean, I know clearly direct lending and other private markets have probably seen a bigger impact with this growth of private capital and what that might be doing to deal terms in some of those markets. But what about the structured credit market? Have you seen kind of deal terms change, either deteriorate, too much money chasing too few deals? How has the impact of maybe some of that capital, changed any of the space that you guys, kind of have played in?
So the added demand is definitely felt. You go to any of our industry conferences and there's a whole bunch of private credit people walking around. It's pretty obvious that there's a lot of competition in that space. I would say that on the public side, in terms of deal docs, it hasn't really affected it meaningfully. We're seeing a little bit. So, I think maybe rather than from private credit flows specifically, I think there's just more flow into the structured space overall. I think more insurance companies and asset managers are allocating more capital to structured than they have in the past. So on that documentation piece, we're seeing a little bit in CLOs in terms of degradation. But again, it's on the margin. We're seeing some managers put in some additional language or maybe omit some language in some cases that gives them a little bit more flexibility. But on the chasing too many deals or too few deals rather, it's felt that way for 6 to 8 months now, to be honest. There's a lot of capital being invested in this. When I look at subscription levels of new deals, that's a pretty telltale sign for us. Most esoteric deals are getting done, 2 to 3 times oversubscribed on the senior classes, a little bit more than that on the subs, which obviously offer more spread and they're smaller in size. On the CMBS side, it's a similar story. If we see a clean SASB deal that comes out, it usually flies off the shelves. And one last piece that we can see the amount of credit or rather capital coming into our space is just the amount of inventory on dealer balance sheets. And that's been really light for a number of months. So, the market, at least on the public side, seems like it could absorb, maybe 1.5 to 2 times the amount of net supply that we're seeing. And some of that might be private credit or private capital finding its way back into the public market simply because there aren't enough deals. But for sure that technical is a very, very strong tailwind to our market, and that's reflected in spread levels.
Before jumping into my next question, regarding issuers, tell the audience a little bit what is kind of your role cover at Conning, a little bit more about Conning more holistically. Just kind of curious what you cover on a daily basis and a little bit more about the firm.
Yeah, sure. So as you mentioned at the top, Conning is predominantly an insurance asset manager. We manage assets on behalf of our clients, which are predominantly insurance companies, mostly fixed income focused. And I would say, my role as the head of structured is to oversee trading and research for all the various structured sectors, including asset-backed securities, CMBS, agency mortgages, ABS, and et cetera, et cetera. There's even more. But I would say, broadly speaking, from a firm-wide perspective, we've seen our slice of the AUM pie, so to speak, grow quite a bit in the last 2 years as structured has really been where most of the relative value has been away from, IG corporates with spreads at, pretty close to 25-year tights there. And folks are just generally getting more interested in structured products. There's a lot of different duration targets you can hit within the space. There's plenty of relative value versus more on the run sectors. There's lots of liquidity. So, we're definitely seeing an increased interest in our side of the firm.
Getting back into maybe some of the things you're starting to see in deals, have you started to see new issuers participating in deals, and maybe a little color as to types of issuers you're seeing in these transactions?
Yeah, definitely. Seeing a lot of new issuers. I think companies are realizing the benefits of securitizing future cash flow streams for a couple reasons. I think number one, to distribute the risk off their balance sheets. Number two, to access the capital markets and generate some additional funding for future growth and lending, to help support their businesses. And to be honest, to do it in the capital markets in it with an investor base that's traditionally very sticky, repeat customers in the form of money managers, insurance companies, pension funds, and the like. I mean, we're seeing a steady growth, and I think folks are realizing the benefits of that. And I would say, in terms of the kinds of issuers we're seeing, we usually see a handful of new auto lenders, maybe a couple of new CLO managers every year. But we've clearly gotten a fair amount of new digital infrastructure entrants, particularly in the fiber and data center side. There's a lot of capital being thrown at that space with the buildup and the AI arms race that I think it has a natural draw for firms that have really deep pockets and want to get involved in that. So, that's definitely an area of growth that we're seeing pretty heavily right now.
And that's certainly one sector we'll dig into a little bit more in a few minutes. But what about the blending of private and public capital? Has that adjusted thinking on whether it be sectors or segments in the markets? Maybe a little bit more on kind of the and if you're seeing a lot more blending of public and private capital.
Yeah, for sure. In some ways, we do see issuers tapping both the private market and the public market, and in some ways, I think it's healthy for issuers to explore other avenues to finance debt. And on the ABS side, we've seen investors tap both of those markets for financing, and sometimes it's within even the same deal. So, you'll see a deal come out that will have a public senior tranche and maybe a tranche below that that's a 4A2 private tranche. So not only is it blending together with how they finance debt, but sometimes often within the same deal. So, and I wouldn't say that we're seeing private capital necessarily crowd out the public issuance of structured debt. We're coming off record supply numbers for last year, so we're not seeing that yet. I think the one thing where it is pretty clear is in the residential space. There's been a lot of private capital taking down very large pools of whole loans in bilateral agreements. So, and that collateral would have otherwise made it into securitization. So we're seeing some of the effects there. But it's, again, it's clear that when you go to industry conferences, the amount of firms that are deploying private capital, and even talking with some of the issuers in the public space, they have private firms coming to them saying, "Hey, we want to buy a pool of whole loans to put on our balance sheet," and those yield bogeys have actually reduced over the last couple of years. So they're willing to take a little bit of a illiquidity concession versus public markets, which again tells me that competition's really high there.
Would you say that's a good thing for the market?
Yeah, I think in some ways it can be. There's again additional routes of funding for issuers. But on some level, it can get a little tricky when you are trying to deploy capital in the private space, especially if deal documentation is getting degraded and you're willing to accept, slightly less favorable terms.
You've mentioned a couple of asset classes on here. One thing we've certainly heard, and I've heard talking to folks on here and for some of our conferences is the opportunities in some of the more esoteric asset classes, given some of the run asset classes, things are getting tight and people are looking for additional yield and opportunity. Are you seeing the same thing? Are esoteric opportunities becoming a lot more appealing in today's environment?
Yeah, thankfully, we've been in the esoteric market for quite some time. That's kind of our bread and butter. And there's definitely a case to be made, for more esoteric opportunities. I mean, look, there is a case to be made for on the run ABS, in particular as a place to hide out if you're expecting spreads to widen out for some, sort of black swan event to come, heightened volatility. So there's a value to that too. But and again, what's funny to me is that even when you look at something that is normally viewed as one of the safest sectors in asset-backed securities and bank issued credit cards, there's some headlines swirling around there with the 10% cap. Now, to be fair, we haven't seen spreads widen out, but the point is that no sector is really truly safe, I would say. But more on the run stuff. We were big fans of agency mortgages last year for a lot of reasons, but after January's really aggressive move tighter, we're leaning into structured credit even more, particularly in esoteric ABS and parts of the CMBS market. So I think ultimately capital will make its way into other structured sectors versus more on the run stuff, especially after the performance we saw in the first 3 weeks of the year in the agency market. But again, it's the esoteric market offers a lot of additional yield pickup over more on the run sectors. You've got structural protections. There's a lot of things that are very attractive, especially to insurers.
Is there a clean definition of what people consider esoteric these days?
Yeah, it's always up for debate a little bit. I think pretty clearly you're talking about, prime auto credit cards, that's on the run. If you're
Yeah.
talking about music royalties and data centers, that's certainly esoteric. There is a blending in the middle. I'd probably cuff it around subprime auto. Once you start getting into a little bit more off the run from that, then you're
Yeah.
probably talking about esoteric. But yeah, it's a bit more of a blending than public and private capital for sure.
So answering a question a few minutes ago, you obviously referenced one of the hottest topics there is in the market today, which is, AI, which certainly relates to data centers, fiber, and other pieces of the market. Where would you say we are with data centers and the expansion of AI? Are we, entering a bubble? There's been a lot of bubble talk around it. Are we in a bubble? Maybe go into a little bit deeper into the digital infra play right now and kind of what you've seen from your seat.
There's been a lot of ink spilled and a lot of airtime filled with this topic. But it's a big trend. I totally get it.
Yeah.
For us, it's a bit of an old hat. We've been doing data centers for a while now. But I will say that we're entering a stage where we're starting to exercise a lot more caution. I'm going to try and very cheekily not answer your bubble question here. Um,
Well, I guess
so
I would rephrase it maybe in saying, let's put the bubble piece aside for a minute. Where are the biggest risks in the space? Is it technology that, with DeepSeek and other things, has it proven that maybe the reason data centers exist is potentially not as long term as you might think, or where might be the biggest risks in the market today?
yeah, no, that's totally fair. The biggest thing that I think about is that we don't know what the future of this space look like in terms of adoption rates, productivity increases. It's tough to say if we are in a bubble or not.
Yeah.
But I think it's more difficult to say how quickly uh, changing technology will, in fact, change over the lifetime of a deal that we're invested in. So normally these have, somewhere between 3 and 7 year maturities when they come out. And if you're talking about technology that evolves every 3 years or every 5 years, there could potentially be a big maturity wall for this sector if supply keeps up like it did last year and probably will this year. What I will say is that there will be winners and losers here.
Yep.
I worry about how much leverage this particular theme has right now in terms of the way that it's impacted financial markets, consumer wealth effect, the stock market, consumption, and really economic growth, writ large over the last 3 years. So, I mean, if you take a step back, whether you like it or not, it's creeped into every corner of our lives. Like I said, equities are higher, the wealth effect, your net worth is higher, consumption higher, the housing market's higher. There's a ton of knock-on effects from this.
Yep.
My concern is that if we see any sort of drawdown in equities, and again, the top 10% of consumers are driving consumption here in the US. If there's any sort of equity drawdown, net worth, mean reversion, that the sectors that have experienced that knock-on effect will come back down to earth. So it's a bit of a long-winded way of saying that a lot rides on this working out over the short to medium term. But ultimately, what that means for us is that we're definitely taking a cautious approach. There's a ton of data center paper out there in the market. There's going to be a lot more. So we're making sure that our pencils are sharp when we're adding incremental risk here.
Would that answer have been different 12 or even 24 months ago in terms of like, hey, there's some caution here? Is it based on some of the news items you saw last year where some of the build outs were like, hey, maybe we should tamp this down? I think some of the large tech firms were like, hey, maybe we won't do as many data centers or we'll put a pause here. Like, is part of it some of that from the issuer side, or is part of this the, just overwhelming demand of the capital that's just entered the market as well?
I think it's a combination of those two things. Like
Got it.
there's been a lot of capital flowing into this, both from the investor side as well as the build out side. You really need to have a firm that's backing you that has deep pockets to get involved in this space. That if you look at a data center as what it is, it's basically just an empty warehouse.
Yeah.
And so there's plenty of spots to that, to build that kind of stuff all over the country. The problem is the power and the guts of the data center itself. That's where, you need a lot of heavy capital and a lot of heavy lifting. So there has been a lot of capital chasing this. And I think early last year we started thinking about some of these headlines, and we really took a team meeting and said, okay, we need to start making sure that these are companies with sustainable business models. This is going to be their actual business. They're not in this for just a quote unquote trade
Yeah.
that you can see sometimes with really cheap funding.
Yeah, another question I had, and we have a couple minutes left before we get to the fun questions. As we look to wrap up in a few minutes, though, is when you have a trend like this, does it maybe open up opportunities in some of the other pieces of the market? Like there's so much money chasing data centers. Does then credit cards or mortgages or other parts of the market say, "Ooh, maybe some of that money has exited those. Maybe there's opportunities that we wouldn't have looked at in some of these other on the run or other asset classes." Does that effect happen?
Yeah, and I think that's where we're paid as investment managers, is to find that relative value.
Yeah.
And if you look at all the news and all the focus that's been on digital infrastructure, but if you take a step back on ABS, for example, the the increase in digital infrastructure definitely happened last year for sure. Uh, but the overall issuance of ABS was up big last year versus the last
Yeah.
couple of years. And just some numbers. So in 23, we had 230 billion. 24% of that was esoteric ABS. 24, you had 320 billion, and a third of that was esoteric ABS. And last year, with about 350 billion, and again, another third of that was esoteric ABS. So yes, digital infrastructure is higher, but if you
Yeah.
look at places like aircraft, that was up 95% last year. Consumer loans was up 60%. Music royalties are up 30%. So there's tons of other options within even just ABS alone. And then you layer on top of that residential mortgages, in the non-agency space, CMBS issuance has been up big over the last couple of years. So just to the point we were making at the top of the show, when agency mortgages got really tight over the last couple of weeks, it's our job to try and figure out where the next dollar of incremental capital goes to. And I would say, our team has the capability to look through at some of these other lesser known collateral type of instruments, and really do the homework and find where we can get the best value for our clients.
Final question for the fun ones. You had referenced obviously the announcement from the administration on the potential for the 10% cap on credit cards. When something like that comes out, does your phone start ringing off the hook from your investors of, hey, what are we doing here? What does this mean? Do they take a more pragmatic approach? Like, just kind of curious how that dynamic works out, even though it's not something that's been fully, done in the market yet. But when something like as that takes up the oxygen of the news networks, does your phone start ringing off the hook for from your investor base?
My phone has been ringing a bit more since January of last year, I can tell you that much.
I
With
would
that
think
being
so.
said, yeah, with that being said, look, I think our clients entrust us with their capital.
Yeah.
First and foremost, it's about, principal preservation, some capital appreciation in there as well. We are we are our subject matter experts within the firm, and we have a client base that's, has no problem hopping on the phone and getting a download, and we have no problem giving that download. I mean, ultimately, these are not all the time are they CIOs of insurance companies. Oftentimes, we'll be talking to a CIO or sorry, a CFO or a CEO who maybe isn't as in the weeds in the capital markets. So we do answer quite a few calls. We're happy to get on the phone with clients and talk about the issues, and also like what our take is, what our thoughts are around the
Yeah.
things like a 10% credit card cap for a year. Do we think it would actually come to fruition? What does it mean for the market? How would we reposition? So yeah, it does happen. We're personally, I like fielding those questions because it gives me a view on how other people are looking at the world outside of myself.
It also shows you they're paying attention and they're, kind of engaged in what's going on, which is good.
Yep,
And you want to see
exactly.
that. So we have just a few minutes left here. I always like to end a little bit lighter on the question front. So do you have a favorite sports team and or hobby?
I have been a Manchester United fan for 20 years, and it's been a roller coaster. It started off really great, and the last 10 years I have been a glutton for punishment, but I keep coming back. I also like traveling a lot with my family, introducing my kids to new places, new ways of life. That's pretty cool to me.
One surprising thing about yourself.
I have been a snowboard junkie since I was about 12, which looking back was sad to say is about 30 years ago. But recently I got my kids into it, hitting the mountain, and I love seeing them, learn a new skill and just spending time with them.
Lots of snow coming our way here in New York. So,
Yes, yes, for sure.
one book that you'd recommend reading.
That's a lot to think about. Off the cuff, I would say anything by Haruki Murakami. He's a Japanese author, and maybe specifically 1Q84, or Wild Sheep Chase. Those are two of my favorites.
Most exciting part of your job.
No day is the same. Um, I've been in, data entry jobs in a long time ago, and it was painful, but no day is the same here. I get to geek out on financial data, intricacies on how it's collected, how it affects financial markets. And the thing we just mentioned, I also like hearing different market views from colleagues and clients to
Yeah.
try and help formulate our own views and ultimately, test our confirmation bias and move away from that if we need to.
And then final question, one prediction for this next year that we just entered.
As it relates to markets, um,
I mean, it could be anything, but I
okay.
would probably say, given our conversation, something relatively close to structured credit.
Well, one thing off of structured credit, I'm really
Sure.
hoping that the Patriots have a path to the Super Bowl here. Uh,
Well, now I'm not sure if we have continued this episode, so
uh-oh.
because I'm a Bills fan, so
Oh, uh-oh. Well, let's switch
yeah.
to financial markets. So, from a macro perspective, I don't know. I think growth and productivity will come in surprisingly high above consensus. But I also think inflation will too. Um,
Yeah.
that we always think about what the Fed will do versus what they should do. And, I think with a new appointment of a Fed chair, we could see a bit more of a dovish Fed. But from where I sit, I don't know that there's any reason to continue cutting rates. Um, and I think it's probably not headline grabbing here on your show, but I think we're in for another record year of structured supply. We're going to beat 2025's numbers.
I think that's a good place to wrap up. Good luck with your Patriots, though you guys have certainly figured out ways to win lots of times, which we can't continue to fall short and do something in. But really appreciate your time, Mike. I appreciate you spending at least a few minutes with me here. Continued luck for you and the firm, and hopefully we'll get you back sometime in the future.
Great. Thanks a lot, Todd.
Yep, appreciate it.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.